Is my screen visible to all? Can somebody confirm if my screen is visible? Hello, I'm looking for some participation, some confirmation. Somebody please speak up if the screen I'm sharing it is visible.
Yeah, it is visible.
Yeah, yes, sir, visible, sir.
Okay, great. So welcome to our class on swap. Swap, as we all know, happens to be one of the daunting areas of most of the candidates in FRM as well as in CFA. Hello. Hello. Am I audible?
Yes, you are audible.
Yeah, sir.
Okay, the screen is also
everything is fine, sir. Continue. Okay, you can continue. Everything is fine.
okay, great. So at any given point in time, if there is any technical difficulty at my end, please do not hesitate to raise your hand. Okay. There is somebody, Nodluva. Siboniso Nodluva. Okay. So admitted. Okay. So let's start. All right. Okay. So begin with, swap is basically a derivative contract. So what is a derivative contract? So the derivative contract is something which derives its value from the underlying. That's what we talk about as far as derivative contract is concerned. So mostly the swaps are OTC derivative contract, which means that these are instruments that are being actually traded between large institutional players, unlike retail persons or retail people. Okay, that's number one. Number two, because they are large institutional players, so most of these contracts are OTC contract, which means that they are not publicly traded. Okay. Number three, that you also must understand that it is not as simple as it is we are going to actually study as far as our curriculum is concerned. The depth and analysis, the legality part of it, and there are a host of other operational requirements which go into actually drafting a swap. Okay, so it is as much as about the legality of the swap as that of the underlying financial transaction itself. Srivarani asked for passport. Did you guys require any passport there? I don't think so. Okay, so now what is the purpose of swap? So there are a couple of purposes of swap, and the first and the most important purpose of swap is basically to hedge. Do not forget, there is actually mostly it is used for our hedging purposes only, and it's not meant for speculative businesses. Okay, that's the first bottom line that you must understand. Okay, now what do they do in case of swap? There are two willing parties, two large institutional players, and they agree on the outcome of certain variable. So this certain variable is basically got to do with the movement of the underlying. So that underlying could be interest rates, that underlying could be your equity stock portfolio, that underlying could be commodity, that underlying could be XYZ, even real estate as well. Now the relative movement of the underlying will denote where one party will actually receive cash flow while other party will be making those cash flow. Okay, so that's the bottom line. That's how things happen. Now there are two things while we discussed are important. So the first thing is that swap will invariably have something called as credit risk. And swap, so far that it is a domestic contract, the credit risk is being minimized through a process called as netting. So netting, as you may understand, that it's in principle, it's a very simple thing. That let's say there are two parties, A and B. So let's say A owes B 50, and B in turn owes A 45. So as far as domestic transaction is concerned, the bilateral movement will be such that A will in effect pay B 5 only. Now, why is it so? Because when you do so, the credit risk is considerably minimized instead of somebody actually making a wholesome adjustment. For example, if A pays B whole 50 and then waits for B to make 45, then there is a greater risk that B actually may not make the payment. Okay, so that means the risk would be at A's end and to the tune of 50, which is much bigger than the net cash flow itself. Okay, so that's first thing that we need to understand about swap. Okay, so I read out the definition. Now, mind you, this definition is my analysis, my synthesis. A swap is a derivative contract between two willing parties to transfer cash flow, either to hedge an existing risk, which is cash inflow or outflow, or speculate on a possible outcome of the underlying. Now, when we say this is speculate on a possible outcome of the underlying, this is highly specialized and may not form more than 5% of the total swap transaction, which means that 95% of the swap transactions that happen worldwide do happen with the objective and motive of hedging only. All right. So next, let's understand that how many types of swap could be there. So before actually I boil down, let me give you certain scenarios, and we're going to repeat these scenarios as we move forward. Okay, don't worry, we are not going to solve any problem as of now. Okay, it's important for us to understand. So the first thing is the interest rate dilemma. Let's say we have two borrowers. Okay, and borrower A have a loan obligation of $500 million for 7% fixed rate for the next 10 years. And he anticipates that the near-term interest rate may decrease drastically for the next 5 years. The borrower understands that it would be an indirect loss on account of higher payment. Payments are affected annually. Okay, so let's just try and figure out what exactly it is being talked about. Another thing, as we proceed with the workshop here, I must make it a point that I do not prefer to solve any question or any numerical for that matter through formula. Okay, this is something that you also must avoid it to the extent possible. Not that you will be able to fully avoid them, but if you try to learn or understand any concept through formula, take it from me, you are bound to fail in that formula. You would actually, because that they are not going to test you as simple as A plus B whole square. That's not what the purpose of the FRM exam is. So the best way of learning derivatives in particular, or even for that matter, fixed income, is to draw something as the timelines. Okay, so here we are talking about the borrower A. This is time t is equal to 0, and this is time t is equal to 10. So in between there are 10 periods, right? And it says that it makes an annual payment. So we have T1, T is equal to 2, T is equal to 3, 4, and 5, then 6, 7, 8, 9. So these 10 periods are there. So he understands that when he took out the loan, the borrower A took out the loan. At that particular point in time, the available rate of interest that was most favorable, mind my word, most favorable. Some keywords I will emphasize for you to note down as well. So the favorable rate of interest for borrower A at time t is equal to 0 was a 7% fixed interest rate, which was applicable for the next 10 years. Okay. And while he entered that, sometime down the line, he anticipated that for the next 5 years, so that is from time period here to here, let's say. So then next 5 years, this 7% rate of interest is not going to be remain at 7% at all. It may actually come down to 6%, or let's say even 5.5%. So in view of that, if the borrower makes an annual payment of 7%, in effect, he is actually incurring a loss to the tune of 1 to 1.5%. In other words, from 100 basis point to 150 basis point. This is the amount of loss that he will incur, the institution per se. Okay, so this is one scenario. Exactly opposite is the scenario for borrower B. The borrower B anticipates that the near-term interest rate may rise beyond what is being predicted by the LIBOR reference rate. Now, LIBOR is one of the phasing out, to be phased out soon reference rate, but still I'm making use of it. And in your exam also, there is slight possibility that LIBOR may be mentioned. Okay, doesn't matter. Instead of LIBOR, you can call it SOFR, SONIA, Doesn't matter. So borrower B anticipates near-term interest rate rising beyond what is being predicted by LIBOR reference, and he also has an obligation of, he also has an obligation of $500 million. Okay, that is currently serving for the balance 3 years. Payments are being made annually. Okay, so what do we understand from here? So from here, a few things noteworthy is that we are talking about borrower B, and borrower B has remaining tenor of the loan that he has taken. When I say he out here, I'm actually using a gender, but you must understand this is basically an institution. So we are talking about 3 more period, annual period that is, and he's paying, the institution is paying borrower B at a floating rate, and the floating rate is pegged or is benchmarked to LIBOR. Okay, now in this particular case, he was paying a reference rate, but he at the same time has now got a problem. And the problem is that since the floating rate is likely to change at every resetting date, he anticipates that maybe, just maybe, when the next resetting date comes, the LIBOR will not remain favorable for him, but it may rise. It may rise proportionately. So if it does rise, then that would mean that he would actually be making more payment than what he had actually anticipated. So there is a positive risk that he is actually buying in. Okay, now this is likely to persist for how many years? For the next 3 years. So 2 different parties, 2 different scenarios, same market, 2 different viewpoints. Okay, now in this situation, can a mutually satisfying solution be found out? The answer is yes, at least for the next 3 periods. Remember what exactly has happened. We have borrower A that anticipates that the market interest rate will actually come down. And we have, when I say market interest rate, we are talking about the floating interest rate. Essentially, he has borrowed at a fixed rate. And we have borrower B that has borrowed at a floating rate, anticipates that the market interest rate may go up. So in order to hedge this scenario, borrower B would be better off if they can find a counterparty through which effectively, not directly, effectively, he can actually transfer the liability in a fixed loan rather than a floating rate loan. Exactly opposite is the case with borrower A. When borrower B, because of the expectations that borrower A has, may want to find a counterparty to which it can actually transfer the risk and effectively, not directly, effectively borrow at a floating rate of interest. Okay, the swap intermediary, more often than not, which is basically a large-scale bank of international repute, comes to the rescue. They are the ones who are more often than not specialized in this kind of job, and they would actually work the intermediaries role out here. Okay, so they would work the intermediaries role out here, and they would facilitate the transaction. And the transaction would be wherein the borrower A will be, since it wants to transfer in a floating rate, the borrower A will be exchanging the principal. We're talking about the domestic transaction. So in this domestic transaction, the exchange of principal is only going to be notional, because you may understand that domestically exchanging $100 million for $100 million, it means nothing, right? So there's just going to be a notional principal transfer between these 2 parties with the agreement that borrower A is going to pay at the rate of LIBOR reference rate, okay? And borrower B is going to pay at a fixed rate. Whatever that rate be, we will come to that later. That's not the problem out here, okay? So effectively what will happen, borrower A will be paying LIBOR on a $500 million obligation, and borrower B will be paying fixed on a same $500 million obligation. Now see what happens. This fixed amount is actually going to fund the borrower's fixed liability out here, okay, with the original lender. This is the original lender. Similarly, this floating rate, which is referenced by LIBOR, is going to be serviced to the original lender of B. This is the same money that will be coming in, and then borrower B will be remitting it to its lender. Of course, in here, we are discarding or ignoring any transaction costs or any tax implications. Of course, those things we are discarding altogether. Okay, so this was scenario number 1. Scenario number 2, let's say we have got a couple of companies. One is based out of Germany and another is based out of India. Okay, now when I say based out of Germany or based out of India, they are headquartered in their respective countries, but also they have some sort of business interest in their respective country. Maybe they have a supplier to whom they have to pay, or they have to raise some capital because they have to set up a shop there, an industry if you must. Now, here is a problem. Let's assume from the point of view of the Indian company first. The Indian company wants to raise capital here in Germany, right? However, when we see the rate of capital, rate of interest or rate of capital, whatever the case may be, okay, so the rate of interest that is being prevalent in Germany is 14% per annum. Okay, now here I would like to pause here and invite a quick discussion from one of the participants out here voluntarily. 14%. Oh no, sorry, it's my mistake. Now, yeah, so in the Indian company, or when it wants to raise capital in Germany, it sees that the rate of interest prevalent, the risk-free rate of interest we're talking about, is 14%. Okay. Sorry, Indian company sees it's the prevalent rate of interest is 6%. Yes, this is the risk-free rate. I'm sorry, this is the risk-free rate, and the German company bases the 6% risk-free rate can raise the capital at 8% interest. However, when the Indian company wants to raise the same capital, the rate of interest is around 10% plus, which is 10% northwards. Okay, this is a problem. Now why do you think that the Indian company will be charged 10% while the German company can be charged 8% only in Germany? Can anybody answer me quickly?
The credit rating.
Anybody else? Anybody else?
Maybe the country of
Maybe
origin
because
of the company.
Yeah, one by one, please.
Country of origin of the company.
Country of origin of the company. That's absolutely correct. In fact, what happens is that it is because this company that we are talking about, let's say this is company B and this is company A. So B is headquartered or domicile in India. The laws and regulations will be for Indian company in India, which may not be applicable when it wants to raise capital in Germany. Okay, because there is a considerable risk of a foreign element coming here in Germany, which is domiciled elsewhere. Hence, the same rate of interest as any other German company would be there, would be able to raise that will not be given. That will not be given precedence. So a German company in Germany can raise a capital at 8%, but an Indian company wanting to raise capital in Germany will be able to do so at 10% or more than that. Okay, the similar logic is extended here. The Indian company, which is headquartered in Mumbai, wants to raise euro 625 million in Germany, the prevailing rate being 10% per annum, as I said before, right? For Indian purposes, the Indian company can raise at 10% domestically flat for 5 years. The risk-free rate is 8%. Now, when we talk about German company, it sees the German company sees that an Indian company is able to raise capital at 10%, but when it comes to him, they will be able to raise capital at 14%. Why? Because the same rating, because the same logic extends here as well. Even if the credit rating of both of the companies are same, it won't matter. It will always be the case. Okay. Now, if this is a situation, can there be a solution that can be found out in such a way that both the parties have a win-win situation? What do we mean by win-win situation? In this particular case, how about the German company raising euro from the Bundesliga Bank and the Indian company raising capital from, let's say, Punjab National Bank, and the amount of capital is same. It is Indian rupees 50 billion equivalent to German euro 625 million. Okay. If the amount is same, all that they are doing is that they are actually raising capital on behalf of the other party. Okay. If they're raising the capital on behalf of the other party, then in such scenario, all they can do is to exchange that principal. So that means the German company will be lending the Indian company 625 million euro, while the Indian company will be lending German company INR 50 billion. Okay. And since it has raised at the rate of, let's say, 10%, which it can, which we just saw that the Indian company can raise in India domestically at 10%. So it will charge the German company 10% for the capital that it has raised. Okay. So the Indian company will charge the German company at the rate of 10%. Maybe some margin they will keep because of the transaction cost and etc. etc. So, but in effect, they're going to charge 10%. And similarly, the German company will charge the Indian company at the rate of 8%. Right? So in effect, what has happened? The German company has saved a considerable 6 percentage point, because if it had to go on its own, it would have to raise capital at 14%. Instead, now it only can make the payments to the Indian counterpart and save 6%. Of course, I am ignoring all the transaction costs and the tax implications and if there be any internal markup. Similarly, on the Indian company's part, they are also saving. Why? Because they, instead of raising the capital at 10%, they're now keeping it at 10. Instead of 10%, they're now doing it at 8%. So that means there is a 2 percentage point savings here. Okay. So is this a win-win situation? Yes. The answer is this is a win-win situation. So this was scenario number 2. Scenario number 3. Let's say there's a large institutional player, and that large institutional player has, let's say, a $500 million portfolio and $500 million portfolio of stocks. Now, let's say that it is still pretty well diversified, but seeing the current global turmoil, just after we have emerged from the global pandemic of COVID, we have now a war-like situation, or we are already in the midst of another global crisis. So it believes, this institutional player believes that this $500 million portfolio is very attractive to me. I have built this portfolio over a period of time, and though the situation may be bleak for the next 6 months, but I don't want to actually liquidate this portfolio at all. I want to keep this portfolio intact, yet I would want to arrest any downside risk. If there be any downside risk, I would want to arrest that. So he wants to see how he can do that. So here comes a solution. So there is a dealer, and that dealer actually exchanges fund in the market. Of course, it's again an OTC product, wherein it actually mimics the ETFs, exchange traded fund. And this ETF is based on, let's say, some stock index, or let's say a bond market, a bond portfolio, okay, which in other sense is going to pay a more regularized and more predictable return. Let's say more often than not, it's actually a fixed income portfolio. So in this case, if they actually exchange this risk, so in this case, this person may be, this institutional player that we are talking about, this institutional player may be fully protected because he has transferred the risk of transferred the risk of he actually the downside risk that he was anticipating for the next 6 months. Of course, on the contrary, the bond dealer or the market maker out here may believe otherwise. The market dealer may believe that the situation may not be that bleak. Maybe for the first couple of months, situation may actually not be that good. But after that, for the next 4 months down the line, the stock portfolio is going to zoom. And hence, against a fixed return of, against a fixed portfolio remittance of, let's say 6%, I can get a heck out of higher in the equity portfolio market. That may be 15% also. I don't know. So these are two different views which are there. Okay. But in this case, both these cases, in this case as well, they have mutually transferred the risk to another party. Okay. Now, along with these three that I have just discussed, the domestic interest rate problem, the foreign exchange rate problem, then we talked about an equity portfolio problem as well. Well, in case of foreign portfolio, there is one more thing that I must add out here, that these transactions between A and B could be a financial institution transaction or a non-financial institution transaction. There is going to be a little bit of a difference to that. When we study comparative advantage, we will know about it in details. But as of now, do understand this, that the non-financial institutional transaction, cross-border that is, they carry considerably greater amount of risk as compared to financial institutional transactions. For instance, if let's say an ICICI bank wants to actually enter into a swap transaction with the Bank of Germany, an XYZ Bank of Germany. So both being financial institution, the respective credit risk of both the banks would be considerably lower than if, let's say, a Tata Motors and a Volkswagen would have entered into similar kind of swap transaction. Okay. Now, are there any other kind of swaps? Yes, there are other kind of swaps as well. For example, the credit default swap, commodity swap, and volatility swap. So I'll just touch base upon them because they per se, from the exam point of view, they're not that important, but nonetheless, I believe that you should be knowing about them. A credit default swap, in all fairness, is basically an insurance contract, where it differs from a proper insurance contract is that in case of a credit default swap, neither the insurer nor the insured may need to have any underlying insurable interest. What is that? So let's say, for example, you have a house, or let's say you have a car. So you insure your car by paying an insurance premium at the beginning of a policy year, with the understanding that you are going to pay the premium, and if there be an unfortunate event in the form of any sort of accident, any sort of breakdown, any sort of damage, the insurance company is going to make good of that. Okay. Now, in this case, the insurance company undertakes the risk because there is an insurable interest, and the insurable interest happens to be the car. Now, imagine against the same car that we are talking about, let's say I also actually book risk underwriting on that particular car, but I don't own that car. Somebody else also does the same. All that they have to do is to pay this amount. Okay. Pay this amount, credit default swap. So they're just going to pay that amount. That's it. This premium is going to be paid, and the insurance company happily collects all the premium that's actually accruing to them without actually verifying. And it's not a question of verifying, without actually taking into cognizance that the number of purchasers or the number of buyers, not all of them have any insured, then all of them have the similar or the same insurable interest. Okay. So this is exactly where a credit default swap differs from that of a pure insurance contract. In 2007, 2008, this instrument played havoc in the subprime crisis and the financial crisis world over that we witnessed. Now, in case of a credit default swap, all that it happens is that there is something called as a reference asset, which we talked about, but for natural, that there is no obligation and there is no mandatory requirement that the purchaser of this contract need to own the reference asset. However, if there be a default on that reference asset, a default would be either a pure default, for example, a bond portfolio. So in case of a bond portfolio, the default would be when the issuer of a bond fails to pay the coupon on time, or the issuer of a bond fails to make the principal payment, either amortized or bullet, or actually the term maturity when it's due. So when either of these or both happen, then it say that it is the issuer and the issue have defaulted in the market. And those are called the reference assets. So it's like I actually speculate on those reference assets. And in case any of those reference asset defaults because of the non-payment, then the dealer is going to make good of the loss out here. Okay, but that is as much as you require as far as your curriculum is concerned. Your exam question is not going to actually delve much more than these simple theoretical discussion or giving you a couple of problems here and there. Similarly, there's commodity swap, when we exchange the risk of one commodity portfolio with either an exchange traded fund or with another commodity having a counterintuitive risk. So similarly, there is volatility swap as well. So one example of volatility swap is where we can pitch against something called as India VIX. I'm sure that people who are in capital market, working in capital market, would be familiar with the terminology called Indian VIX. So India VIX is basically nothing but the measurement of the volatility of the tradable equity stock in NSE or BSE. So if I pitch against it, if I actually bet against the volatility or for it, I accordingly may book the swap. So these are the other types of swaps that's there in the month. Now with this, let's come to the last of the theory portion. And as before, I'll stop the video if you have any question at any given point in time, and do not hesitate to ask questions. So swap parties is basically those two parties between which the swap transactions are being actually carried out. Swap intermediary, more often than not, is basically a bank, mostly a large-scale bank, which facilitate the whole transaction, including the legalese. Swap fixed rate, well, this is something that I'm going to dwell in the problem that I'm going to solve. Again, comparative advantage, again, this is best explained through the problems that I'm going to solve. Comparative advantage and swap fixed rate. Credit risk. Credit risk is wherein, A and B, let's say they have entered into a swap contract. Of course, at the initiation of the contract, a swap value is very similar to a forward value, which means that at initiation, they're priced to have zero value. Neither A wins nor B wins. Okay, but after that, once the swap contract has been initiated, after that till maturity, between T is equal to 0 and T is equal to T, which is basically the maturity, interim at any given point in time, one party may have a positive value over the other party. So as we have known before that in case of the credit, in case of swap transaction and interest rate transaction that we discussed, A and B have entered into swap. A will be paying at fixed rate, B will be paying at floating rate, and eventually they will net their payment in order to save on the credit risk. Okay, so they will. So what happens is that suppose the net cash flow accrues to A, that means A is supposed to receive net cash flow. Now, credit risk accrues to the one who wins the contract or who is in a winning position. And in this case, if A happens to be the one to whom money is due, so A also faces the credit risk from B. Collateral. Now, collateral is something which is not very typical of a swap contract. Now, but still, why do I make mention of it? Now, let's understand what's happening. Invariably, we talked about parties, they're having almost similar credit rating, or almost they're large institutional players, the ones who have good credit standing in the market. They're going to be the one who are going to engage into a swap contract. But for obvious that, retail participation in swap contract, they're few and far between, right? Now, when we talk about collateral, essentially we talk of collateral when party A or party B, as the case may be, that's purely arbitrary, one party borrows from other party. So if I have to borrow from a bank, I place a certain collateral, right? The collateral is the insurance that the bank actually takes from me in case of a possible default. But in case of two willing parties, they may have similar amount of credit risk on each other. Now, we may understand that that is more often than not the case. However, there could also be some exceptions. And in those exceptions, one party may post a slightly more margin or slightly more collateral with party A. That's number one that you must understand. So collateral in swap normally, usually 90% of the time does not happen because there is no need for it. Okay. You are entering into a swap contract with your counterparty because both of you are in good credit standing in the market. And then both of you, in case of a domestic swap, both of you notionally only exchange the principal. And in case of international swap, you physically exchange the principal. So it's like if I've already, let's say, exchanged $50 million with, let's say, 750 crore Indian rupees, that would mean that the principal exchange have been exactly the same, which means that the credit risk on one party to another, it is going to be zero. Not that it is going to remain zero throughout the life of the contract, because there could be other eventualities that can happen. The exchange rate may favor one party or the another, or the interest rate may become favorable to one party or another, especially in a floating type of fixed or floating type of interest internationally. So in those cases, the swap intermediary may insist for collateral. And nonetheless, the swap intermediary, when they actually carry out a transaction between two willing parties, they would anyway invite margin, just like your forward contract. If you've done your forward contract, then you would know that there is something called as margin requirement in the form of your initial margin, and then there is maintenance margin, and then there is a variation margin account. The variation margin account is basically nothing but like a current account wherein the regular cash flows are basically recorded. So similar kind of treatment is meted out in case there is a swap intermediary. The swap intermediary, because a swap intermediary more often than not is a financial institution or a bank. So when we are talking about financial institution or a bank, it also needs to safeguard its own interest. Hence, if there be a party A and party B who are willing to enter into a swap with this person being, or this entity being the intermediary, now this intermediary will need to protect its own interest, because this intermediary in turn, in effect, faces credit risk from B's end and from A's end as well. Similar concept as that of an exchange. So to protect its own interest, it may insist for margin. Reference rate is basically the LIBOR reference rate or any other reference rate that we can think of to determine the swap rate, mostly applicable for your interest rate swap transaction. Notional principal applicable only for your domestic transaction, which we talk about. Physical exchange is required for our international currency transaction. Netting versus full exchange, I have already explained that. Dealer quotes. Now, dealer quotes is basically the quote which the bank actually pays. As before, there are bid quotes and then there are ask quotes. So as more often than not, what happens? Bid is the quote at which the party who is entering the swap will be selling the swap. What do we mean by selling the swap is it depends upon what kind of transaction is being actually referred to accordingly. Let's say we are talking about a floating rate interest. So in case of a floating rate interest, if it has to pay the floating rate, then it will be paying, let's say, at a floating rate of 3.5%. And if it has to receive a floating rate from the swap intermediary or a bank, then it will be receiving at a floating rate of 3.4%. Okay, this is what the whole thing is. Same is the case with the fixed rate as well. But obviously, the ask rate is always going to be higher than that of a bid rate, unless otherwise mentioned. And I mark this point very, very clearly because this will be tested in your exam. Unless otherwise specifically mentioned, if you are being given two rates, bid and ask, and you're asked to calculate the rate at which the transaction will take place between the swap intermediary and one of the counterparties, always take the mid quote. Okay, never consider this in isolation or this in isolation. So in this case, if nothing is mentioned in specific, so for me, the swap rate becomes 3.45. Okay, so these are the whole theoretical portion of it. Now let's enter into some problems for us to understand how this thing works. Before I proceed, if anybody has any question, please, let's take a 4 or 5 minutes window or 4 minutes window in order to answer those questions before I enter into the problem solving part of it. Anybody has question, please.
Sir, can you please explain the bid and ask one again? I didn't understood, that's why.
Okay. Let's say there is party A and party B. So party A and party B, they can directly enter into a swap transaction, right? Or they can appoint a bank to do the job for them. Now, which one is safer according to you to carry out the transaction, assuming that these are non-financial institutions? So which is more convenient or which is more suitable or conducive? Appointing a swap intermediary or carrying out the transaction between themselves?
Definitely appointing a swap intermediary. That will be
Swap
better.
intermediary. Yes. Can you further explain why is it so? Why that should be the case?
So here no one can default, that's why.
So first and
Neither
foremost,
party one or neither party two.
yeah. So first and foremost, these institutions are specialized in doing this, right? So when we talk about amateur versus pro, so these are basically specialized. This is what where their fortes lie, number one. Number two, they exactly work as a CCP. Who is a CCP? In case of stock exchange, we know that that is a centralized counterparty. A centralized counterparty, for example, I'm just saying, forget about swap. Let's say this guy is a buyer and this guy is a seller. So in case of a centralized counterparty, how the transaction takes place, the exchange acts exactly the opposite way to each of these parties. So that means to the buyer, the exchange will become seller. To the seller, it will become buyer. And that is how they will carry out the transaction. Am I right? That's how things will happen. The swap also, if it is decided mutually between A and B, which is always the case, more often than it's not even 9 out of 10 times. 10 out of 10 times, these, even though the willing parties may have expertise, still because of the credit risk part of it, along with the speciality, that the specialty in terms of services, specialty in terms of actually drafting the whole transaction and contracting themselves. So they will appoint and employ this swap intermediary. Now, the swap intermediary, when they actually perform these duties, they also in turn face some risk from either of these counterparties. What happens if suppose that this party defaults? This party can default. If this party default, the swap intermediary in turn will still be obligated to carry out the transaction as far as party B is concerned. That's number one. Similar is the case here as well. That's why they require swap intermediary, may require collateral, may act as an escrow account as well. Mostly in case of your international currency transaction, they work as escrow account, wherein $100 million is being exchanged for 750 million rupee, and both this money is being kept here with the swap intermediary bank, so that nobody can actually default. Okay, and then last but not the least, we are now talking about the cash flows. So when we are talking about cash flows, the swap intermediary is also obviously not doing a charity, right? Is it doing a charity? It's not doing a charity. It also needs to make its money out of this whole transaction, right? So when it has to make money out of this whole transaction, that means it has to have some profit motive as well, which is always the case. So that means that the transactions that it will be offering because of this counterparty role that it assumes, it must have bid and ask quotes for the reference asset. Let's assume let's assume that the reference asset or the underlying on which the swap is actually underwritten is an interest rate. Let's assume that this is, let's say, a domestic interest rate only. Okay. Now, let's assume if this is domestic interest rate, now let's assume that A in principle has decided to pay B at a floating rate, which means B will be paying at a fixed rate. That's how they will be paying, right? But in this whole transaction, there lies this intermediary. We already talked about the risk. Now we are talking about the reward part of it as well. The risk that this centralized counterparty or the swap intermediary undertakes. Now we are talking about the reward part as well. Now let's say, as we have discussed before, that depending upon how the interest rate is moving, one party will owe net cash to another party, right? That is going to be the case, which means there are going to be times when A will be receiving cash, and there are going to be times when A will be paying cash. Okay. Now, when we talk about this bid and ask rate, okay, when we talk about this bid and ask rate, because there is a centralized counterparty, when A will be receiving cash, it will be receiving at the rate of 3.2%. And when A have to pay cash, then A will be paying cash at the rate of 3.4%. That's what the bid and ask rate is all about as far as this transaction is concerned. Is it clear? You have any question here?
No, sir. It is clear now. Thank you.
Okay. Anybody else has any question? Or I'll directly drive into problems then. Okay, I'll give you another 30 seconds. If you have any question, just let me know. All right. Okay. So now let's talk about some problem. And mind you, these problems are copyrighted at my end because these problems are actually coming from my stable, and from time to time I will make them public. The other mocks, some of the mocks I will make them public free of cost. Some of the mocks will be available against a cost. But nonetheless, that's not a question here. The thing is to understand each of the topic areas that we discussed, how they pan out. Okay. Party A and Party B decide to enter into a 3-year annual pay swap to hedge their respective interest rate liabilities. The spot lever curve for the next 3 years are designated as follows. The spot lever for time period between 0 to 1 year is 5%. That of 0 to 2 years, that is 2 years spot rate, is 6%, and 3 years is 7%. The swap spread is enumerated to be 100 basis points. Party A wants to enter as a fixed rate payer and receive at a floating rate ditto, but opposite for Party B. Determine the swap fixed rate for this transaction. Okay, so anybody has any idea about the question? Let's appreciate the question first. Understand and appreciate the question first. I would again, as before, require some volunteer. Somebody or anybody would want to throw their point of view. What exactly this question is asking about, or what is the situation at hand? Okay. So let's say, as before, we are not going to use any formula, but simple common sense and some mathematics, which are basically arithmetic in themselves. So we are standing at time t is equal to 0 here, and then we are talking about 3 years, right? Because there are 3 time periods that are being mentioned. So that is t is equal to 1, t is equal to 2, and t is equal to 3. Now what it says is that there are three LIBOR spot rate. Now, mind you, when I say this, here, the LIBOR has been deemed as the reference curve or the reference rate. The reference rate could be risk-free rate as well. The reference rate could be other rates as well. Okay, LIBOR per se is really speaking not a risk-free rate, not anymore. Especially after the 2008 crisis, it has ceased to become a reference rate anymore. It ceased to become a risk-free rate. Anyway, that's for another story altogether because that's being phased out, LIBOR. Okay, so we have three different spot rates given. The first spot rate that has been given is 5%. So it's like this. We have an upward sloping interest curve, spot rates. So this is LIBOR 0 to 1, and this has been designated at 5%. This is LIBOR 0 to 2 that has been designated at 6%, and this is LIBOR 0 to 3. This is designated at 7%. Now, internally, this is how they look like. I'm sure that anybody who would have some idea about how interest rates are not, this is how the spot rates are, right? All right. Now, what is being asked is that over and above this LIBOR rates that are being given, there is a swap spread also. Now, any spread, when we are actually adding to a reference rate, they actually depict or they actually imply the embedded credit risk. And as before, as I told you, that in case of swap transaction, there are going to be some credit risk, even though not much, but they're not 0%. Okay, and that is being enumerated at 100 basis point. So all that it means is that if we could actually take out the LIBOR curve, the swap curve, basis this LIBOR curve, then the LIBOR curve would look something like this. Okay, and this is the 100 basis point that we are talking about. Of course, this is a vertical distance. So this 5% now with 100 basis point, this becomes 6%. This 6% with 100 basis points credit spread, or the swap spread as it is being called here, becomes 7%, and this 7% becomes 8%. And as before, if anybody has got any understanding issue so far, please raise your hand and ask me as much as you can, because these are the building blocks. Now, the question out here is that we have a couple of parties, party A and party B. Okay. With the information that is being given, it is being mentioned that A would like to enter as a fixed rate pair. So here going to pay at the rate of fixed rate. And then B is going to obviously pay at a floating rate. Remember, floating rate do get adjusted at every resetting date. Whatever rates that we are witnessing today, these are the spot rates. Not necessarily these rates are going to remain same as we transgress from one period to another period. For example, at the end of year one, the then spot rate for year 2 and year 3 may not remain at 6% or 7%. They can become 7%, 6% can become 8%, or 6% can become 5%. Similarly, this 7% can become 4%, or this 7% can also become 10%. That's why, and that's how they're called the floating rates. Okay, but nonetheless, whatever be that rate, B is going to pay at floating rate, albeit, of course, the fixed rate plus 100 basis point swap spread, floating rate plus 100 basis point swap spread. Now, given this problem, we have to find out what should be the fixed rate at which A should be paying, which is also called the swap fixed rate. Okay, so any idea how to go about this? Anybody? All right. Now, A, conceptually, we are talking about time t is equal to 0. So we have to construct this swap. So conceptually, as we know that the value of swap at time t is equal to 0, A is going to be 0. Neither party has any positive or definitive value. We know that. Value is same for both parties. That means both of them stand on the same pedestal, whether it's party A or party B. Nobody could be advantaged at the cost of another party. Second, given these rates, but obvious, the fixed rate that we are going to talk about at the rate at which A would be paying B, they're nothing but going to be some complex average of the liver spot rates. Am I right? Anybody has got any doubt here? In fact, to be very honest, this swap fixed rate is actually going to be one sort of harmonic mean of the spot rates that are already being given. Anybody has got any question here? I'm again repeating. All right. So I assume that all of you would have understood this basic concept, because if this does not hold true, then we cannot guarantee this either. This will not hold true, because at contract initiation, the value has to be necessarily zero. That means given this spot rates, the rate at which the fixed rate would be enumerated, that should be nothing but a complex average of these spot rates only, right? Now the question is that how do we find out the spot rates? Well, so there is a trick that has been used, and the trick that is being used is, suppose that rate is C, okay? So in other words, A pays at a fixed coupon rate to B, right? And since both of them have same value at initiation, 100 is equal to 100, which we call in bond terminology, the face value is equal to present value, which we call. So let's assume that the price of this contract here, the price of this contract here is zero. Remember, I never said that the price is zero. I said that the value of the swap is such that it is priced to have zero value. But obvious, the value of a swap is nothing but plus and minus of the payments, right? So at contract initiation, the plus and minus of payments will always be zero. Okay. So let's say the price of such bond is 100, which is also the face value, which, as we say, talk about. And this guy pays C coupon, A pays C fixed coupon to B, right? How many periods? They're going to be 1 coupon, 2 coupon, and 3 coupon. And of course, here, A is also going to pay the principal. So let's say C. What is going to be the present value of these coupons then? I don't think that is going to be any difficult, because this is going to be C here plus C here plus C plus 100 here, because 100 is the face value. So C here, and then this C is being discounted by the swap rate out here, 6%. Remember, this 6% came from 5% plus 100 basis point. So we discount this by 1.06. You could discount this on a continuous basis also. In that case, this will become C into e to the power minus 0.06. I'm doing it on a compounding method, not on continuous basis. Similarly, the present value of this coupon will become 1.07. Of course, it's square. And then this becomes 1.08. Of course, this is cube. Okay. This 100, last 100 is basically nothing but the face value. Remember, this was also our very basic assumption, wherein we say that party A and party B, if they're entering into a domestic swap transaction, interest domestic swap transaction, they will notionally exchange the principal. So that means 100 principal is being exchanged for 100 principal, right? So this must hold true, right? Can anybody solve this and find me out the value of C? I want you guys to solve it and find the value for me. Am I audible? Is anybody attempting the problem? Is anybody attempting the problem? All right. It's not that difficult. It's in fact very easy. all that we do is we take C common from here. You've done this in your 6th or 7th standard. And we take this 100 here. So this becomes 100 minus 100 divided by 1.08 cube. If you solve this C, then you will find the answer to be something close to 7.92%, which is matching our option A. Okay. Now, what does this mean? This means that given these spot rates, if there be a swap transaction that has to be constructed between two winning parties, in which one party is going to pay at a fixed rate and another party is going to pay at a floating rate, then the fixed rate party must pay at a constant rate of interest of 7.92%. That's what it means. Okay, and receive whatever the floating interest rate comes in. Okay, so this 7.92% is said to be the swap fixed rate. Problem number 2. Let's say we continue with the same example. It is now 6 months post the swap initiation. The spot levers have changed as following. The lever between 0 and 0.5 year now becomes 5.5%. The lever between 0 and 1.5 year becomes 6.8%. The lever between 0 and 2.5 year becomes 7.7%. The swap spread remains constant at 100 basis points. The treasury rates for all the maturities for the next 5 years remains flat at 5%. Determine the value of the swap to the fixed rate pair. Consider the notional premium as $1 million. Okay. Now, what I'm going to do here is I'm going to draw the diagram for you guys first, and I'm going to drop certain hint. I want you guys to attempt it. And if you are unable to do it, of course, I'll do it. Okay, so let's draw the timeline as before. So this was a time t is equal to 0, and this is time t is equal to 3. So we are talking about 3 period annual pay. This is an annual pay swap. We already discussed that the party A is going to pay at the rate of 7.9%. That has been already enumerated, while party B is going to pay floating, and that is this floating is benchmarked as LIBOR plus, LIBOR being the reference rate, plus 100 basis point or 1%. Okay, at each resetting period. All right, so which this being the case, now as per the problem that is being given, 6 months have passed. So that means if 6 months have passed, so we are practically here. This is t is equal to 0.5, right? Now at t is equal to 0.5, there are now new sets of LIBOR that has come in, new sets of changes that have come in. So what it says, this is 5.5%. This is 6.8%. And this LIBOR is 7.7%. Mind you, the curve is still upward sloping, which is also called as the normal curve. Okay, so I hope you understood the difference here. Here we were talking about at time t is equal to 0. Here we are talking about time t is equal to 0.5, because 6 months have elapsed of this contract. Now what it says is that the swap spread remains 100 basis, right? That means that there has not been any relative credit loss or any credit deterioration or any credit appreciation on anybody's part. Now with this, the next thing that is being talked about, of course, is the notional principal. And the notional principal is deemed at $1 million. Okay, and next that is being talked about is that the treasury rates for all maturities for the next 5 years remains flat at 5%. So what is treasury rate? But obvious, it is basically the risk-free rate of interest. The risk-free rate of interest is supposed to be flat 5%. That means the treasury curve is fully flat at 5%. Now all of these information given, we are to find out the value of this swap to the fixed rate pair. So the person who is paying at the fixed rate, what is going to be the value of this swap? Okay. Now, the way to do it, what I will do is I'll drop you a hint in terms of your steps in order to understand the problem. Okay. So the first thing is that in any swap problem, always remember, segregate the cash flows. Segregate the cash flows. Namely, if we are talking about from the fixed rate pair, he's going to receive some cash flow in, right? And then he's going to receive some cash flow out. Okay. All that, any swap problem, of course, there are going to be required adjustments to be made. All that is required is, first and foremost, enumerate all the cash flows, which are obviously in and out, of course. Second is, find the present value of all of these cash flows. Okay, whether it's cash flow in or cash flow out. How do we find out? Of course, by using suitable discount factors. Okay. And third is, then net those cash flows, which means basically in minus out. If this value, if value at 3 is positive, that means the one to whom cash flow receipt is more than cash flow payment. So that part is definitely winning. Similarly, if the cash flow is negative, net is negative, that means he's paying more than what he's receiving. Okay. Accordingly, whatever be the cash flow, accordingly, the value becomes that. That becomes the value. Okay. This 5 steps, if you remember, I don't think that you will be making any mistake as far as your domestic interest rate swaps are concerned. In case of foreign interest rate, we will come to that. Okay. Now, with this, there is one more thing that you need to understand here. And that is, as far as these fixed payments are concerned, the fixed payments are obviously already mapped. We already know what those fixed payments could be. But when we talk about floating payment, the floating payment will only have one payment known beforehand. Okay, we are talking about the floating payment out. There is only one payment that is known beforehand. So if we're talking about, let's say, the floating rate pair, whatever payment is to be made here, that is only known between this time period and this time period, any time, any day that you can think of. The next period's cash flow, whatever has to be paid by the floating rate pair, that can only be known once you have reached this period of t is equal to 1. Then only according to the spot rate, whatever be that spot rate, according to that spot rate, the floating rate pair will be making the payment. Okay, this is a hint for you. Okay, so you know how to map the fixed cash flows. I've already told you in case of floating cash flow, how many cash flows are there, which means that at every resetting date, the floating rate pair's value becomes a 0. Why it says 0 is because it is deemed that he makes one payment, full and final, which includes coupon plus face value at every resetting date. So this is t is equal to 1. Again, here it becomes coupon plus face value, t is equal to 2. Again, this becomes coupon plus face value, t is equal to 3. So for valuation, we have to just consider the latest payment that is to be made from the floating rate pair's perspective. Okay, if this you can remember, it is impossible, and I'm ready to take, I mean, unless you do a silly calculation mistake, that's otherwise, but it is impossible to conceptually make any error as far as swap related problem is concerned, domestic interest rate, that is. Okay, so these are the hints that I have given you. I have told you already the steps that are required to do the job. I've already told you the nature of the floating rate pair, how the floating rate pair will be making the payment. One last thing, and that is, here one extraneous data has been given, and that extraneous data, I want you guys to tell me what would be that extraneous data. And this time around, I'll wait for an answer. Otherwise, I will not proceed. Somebody has to tell me what is that extraneous data. Hello.
Treasury rates for the next 5 years.
Who said this?
This is Uday.
Yeah, Uday, speak a little louder. Kindly.
The treasury rate remaining same for the next 5 years.
This is an extraneous data.
Yeah, because we only need to discount for the next 3 years or so.
Okay, anybody else? Yes, Manoj, you want to say?
Yeah, I think, sir, it's the swap.
Swaps
It's the
spread.
information that the swap is starting 6 months post its initiation.
No.
Mm.
The swap spread is already given, which is constant at 100 BPS, means 1%. That one.
The extraneous data out here. Okay, what happened? Yeah, the extraneous data out here is your 5% risk-free rate of interest. Why? Because more often than not, the risk-free rate of interest are actually used for discounting your cash flows. But in this case, the risk-free rate of interest cannot be used for discounting the cash flow. Why? Because the cash flows itself are not deemed to be risk-free. If that were deemed to be risk-free, then there would not have been referenced with the lever. They have been referenced with the risk-free rate of interest itself. Moreover, there is a constant credit spread or swap spread of 100 basis point that is being added to them, right? So we already demonstrated that how this is being added to them. So if there are being, that is how the cash flows are being enumerated. So we cannot possibly discount a risky cash flow with that of a risk-free cash flow. Okay, that's a risk-free rate that we cannot discount it by a risk-free rate. Only risk-free cash flows to be discounted by the risk-free rate. That sounds logical. I think it does, right? So this is an extraneous data. Remember, GARP will test you in this fashion only. And I see a lot of prep providers, I don't know, want to get into them, who actually run through formula, run through n number of problems without actually addressing these finer nuances, which are required from the learning perspective. All right, so I have dropped you all the hints. Now, one of you have to tell me, I'm not even expecting, if you can calculate right now, good enough. But even if you can't, one of you have to tell me now that how do we proceed to solving this problem? Manoj, why don't you give it a try? Or Siddesh, why don't you do it? Give it a try. All right. So again, no problem. I'll do it for you. So let's go back to the understanding first. So we know at this particular point in time, that is at time t is equal to 0, the value of the swap is 0. That is being established. I don't think we have to go again and again over that. Today here, now we at t is equal to 0.5. So at this particular point in time, we are required to find out the value of this swap. More precisely, to the fixed rate pair of the swap. All right. So how many payments? Let's segregate to the, as you know, let's just follow these steps, as we have said. So you have to segregate the cash flows. So from the fixed rate pairs, you could do it from the floating rate pairs perspective as well. It doesn't matter. So I pick up the fixed rate pair as has been asked. So how many cash inflows, how many cash flows he's making? He's making one cash flow here, one cash flow here, and one cash flow here, right? And what is that cash flow in dollar terms? Well, it's going to be 1 million into 7.9%. That is the swap fixed rate that has been determined in our last slide. So he's going to make 1 million into 7.9%, which happens to be, I believe, 79,000, right? Close to something around 79,000 USD, right? So he's going to make 79,000 USD here. He's going to make 79,000 USD here. And then he's going to make 79,000 USD here, plus this notional principal. Remember, because this was the face value, plus this notional principal of face value. Okay, so these are the payments that he will be making. What is he going to receive? He is only going to receive, as far as this valuation is concerned, obviously he's going to receive 3 payments, but as far as this valuation is concerned, we are only to assume, or we are only to consider the first payment. Okay, we're only to consider this first payment. So here going to receive 1 payment out here from the floating pair side, right? Now at what rate? Well, that rate is already determined at time t is equal to 0, right? It is already determined at what rate he's going to receive. That is already determined. That is already determined. That rate is 6%. Do remember that the next floating rate is not known until and unless we actually come in physicality at the end of year 1. Then only we will come to know the next floating rate. So as of now, at t is equal to 0.5, the floating rate at which the floating rate pair is supposed to be making the payment, that is already known, and that was decided at time t is equal to 0 at 6%. That's already known, right? So what is the cash inflow as far as he's concerned? Well, he is going to get 6%. 6% on how much? 1 million into 6%. That's what. So this is his cash flow out. Each period, of course, we have to sum them up, as I said. This period, this period, this period. And from floating perspective, this is the cash flow in, right? Now, along with this 1 million into 6%, there is going to be plus 1 million also, which is the face value. Because we say that every resetting period, the floating payment, it will become 0. So he is effectively going to make a payment. He's going to effectively receive 1.06 million. I'm roughly doing it. 1.06 million here. Okay. So we have mapped the cash flows. So whatever we have enumerated the cash flows, segregated the cash flows. These are the receipt part and these are the payment part. And now what remains is we have to find the present value of all of these cash flows. Well, how do we do it? So the first cash flow is being discounted at what rate? At 6% rate itself. At 6% rate itself, it will be discounted. The second will be discounted at 7%. And the third will be discounted at 8%. Will it be like that? Will it be like that? The answer is no. Now, the discounting factor that we have to consider is the new LIBOR rates, which are emanating at time t is equal to 0.5. And for which period? For this period, for this period, and this period, right? That is t is equal to 0.5 period, t is equal to 1.5 period, and then t is equal to 2.5 period. So these rates are already being given: 5.5, 6.8, and 7.7. So how do we find out the discount factor then? Well, for discount factor, the way we do it is that we say 7.9 million, that is the first interest payment that he will be making, right? That will have to be discounted at 1.055 to the power 0.5. Am I correct? Answer is no, not correct. Why? Because this is still missing one element. What is that element? I have not added this credit spread, swap spread. So ideally speaking, the way the cash flows now are going to be discounted are going to be each period from the fixed rate payers perspective, each period he's going to make 7.9. So 79,000 divided by 1.065 to the power 0.5 plus 79,000 divided by, next is 6.8%. 6.8% plus 100 basis point, it will make it 7.8%. So 1.08 to the power 1.5 plus 79,000 plus 1 million divided by last is 7.7%. So 7.7% plus 100 basis point, it becomes 8.7%. So 1.087 to the power 2.5. So these are the cash flow out as far as the fixed rate payers are concerned, right? So what is the cash flow in? The cash flow in is only one payment, which is 1.06 million. Okay, 1.06 million. This is the cash flow because we're taking the face value of the floating rate pair as well. Now this is to be discounted by the same discount factor, 1.065 to the power 0.5. Okay, so we have now segregated the cash flow, enumerated the cash flow, segregated the cash flow. We have found out the present value of the cash flow also. Now what we have to do, we have to add these cash flows and add these cash flows. Obviously from a floating perspective, there is only one cash flow, and fixed perspective, there are three cash flows. So when we add all of them, and then the third step we will follow, that we will net them. So if you net them, you will see your answer coming to this 68,660, something close to this. Okay. Now this becomes the value of the swap. Now this is a positive value of the swap to the fixed rate pair, which means that he is receiving more net on a present value basis than what he's paying as far as time t is equal to 0.5 is concerned at this particular position. Okay, this is how thing is done. I know it has been a little complex, but anybody who would require one more round of explanation on this, I'm happy to dole out, because if you have understood this, trust you me, you have understood 40 to 50% of swap related problem that can come. Anybody wants me to repeat this? Anybody has not understood any particular logic that why it has been so? Please ask. I'm ready to re-explain. All right, so I believe that this portion was abundantly clear as far as these problems are concerned. So can I have a resounding yes that if such problem comes in your exam, you'll be able to solve it? Manoj? Okay. All right. So I got a thumbs up from Manoj. So I believe that, yes, this has been clear. I'll send you the copy of this problem also along with the solution if you want. But yeah, anybody's trying to speak something? Okay. We come to the next important topic, and this is also very important as far as your exam is concerned, and which is called the comparative advantage. Now, what is a comparative advantage? We have, let's say, two parties, one A, another B. Both of the parties can actually borrow from the market at either fixed or floating rate, with the understanding that A is somewhat in a better position as compared to B, because A can borrow at a rate of 7% fixed, and while B can actually borrow at a rate of 8.6%. A can borrow in the floating market at a rate of SOFR. SOFR is securitized overnight funding rate, which is replacing LIBOR very soon. So A can borrow in the floating market at a rate of SOFR plus 50 basis point, while B can borrow at a rate of SOFR plus 100 basis point. Now, given this situation, is there an improvement, or is there a hedging that can be done? Okay, that's the question. Now, towards solving these kind of problems, the first step is to actually identify what is the comparative advantage. Okay, what do we mean by comparative advantage? Comparative advantage is where in one party will have specific rate-related borrowing advantage over another party on a relative basis, not on an absolute basis, on a relative basis. So, for example, let's say we are talking about A. So A, we see that it is already in an advantageous position as far as both the markets are concerned, because it can borrow at a rate of 7% fixed, wherein B can borrow at 8.6%. So obviously A is in a better position. A can borrow at a SOFR rate, floating rate of reference rate plus 50 basis, wherein B can borrow only at a reference rate plus 100 basis. So the first question that you may face in your exam is, what is the comparative advantage? Now, I don't want to get you, I don't want you to get into any sort of confusion further, because the book, whether it's GART, whether it's Schweizer's, or I believe they have done less than desired job as far as the understanding part of this is concerned. It has confused students more. But the solution is very simple to this. To finding out the comparative advantage, all that we do is to first deduct the higher rate from vertically and then deduct the rate horizontally. What do we mean by that? So here in the fixed rate market, A has a competitive advantage. A has an absolute advantage of 1.6%. Am I right? A has an absolute advantage of 1.6%. Similarly, in the floating rate market, A has a absolute advantage of 0.5%. Okay, the comparative advantage is nothing but the difference of these two absolute advantages, which is 1.6% minus 0.5%, which becomes 1.1%. Okay, now how this comparative advantage is being played out? Well, this comparative advantage is played out in such a manner that a swap may be designed wherein both of the parties benefit to the extent of 0.55%. This is how a swap is structured. In your exam, in comparative advantage related queries, you may be asked as simple a question like this. And this is how you should proceed. Take the absolute advantage differences and then take the net of those absolute advantage differences to find out the comparative advantage. And third step is simply divided it by 2 to get to the relative differences of advantages to each of the party. So each of the party will benefit if they enter into 0.55, if they enter into any sort of swap. That's the first definition. So now the question is that you should be asking, why do we need to actually get into this? Okay, we understand that, these are two parties. There could be hundreds of such parties. But why do we actually want to get into this kind of mess? So let's understand the thing. Remember, as I said before, in the very beginning of our lecture, that swap is being done. The instrument of swap is being used for risk hedging purposes. That's the bottom line, right? Hedging is the ultimate objective. Swap is not actually entered into with the objective of profiteering, though there are profiteering opportunities and there are few speculators in the market, mostly in the form of dealers who actually tend to profit or actually want to make a profit out of it. But that's not what swap is primarily designed for. Swap is primarily designed for hedging the risk. Okay, so let's understand. Here also, there is no exception. There is a hedging that is going on, and we are going to decipher that. So let's understand what's happening here. As far as A is concerned, A is good enough in both of the markets, right? But in which market it is slightly better off? It is slightly better off, or it is, in other sense, in absolute way, it is better off in the fixed market, relative basis. In the fixed market, it is better off because the difference is huge. On the other hand, B is disadvantaged in both the markets, but on a relative scale, it is somewhat better in the floating market. On a comparative basis, on a relative basis, it is somewhat better in the floating market because the difference is only 0.5%. Okay. Now, always to remember, if this is the case, then A has already used or exploited that advantage, and his existing liability is already in the fixed rate. Similarly, B has already exploited that advantage, and the existing liability is a floating rate liability. Now, remember, if this is the case, then what is it that they are out to hedge? They're out to hedge, as far as A is concerned, the diminishing of floating rate, as we had discussed before, that if the future floating rates, A may anticipate that it may come down drastically, which is basically the SOFR rate that we are talking about. If the reference rate comes down drastically, then A will actually be overpaying. So A would want to hedge that risk. That means A would want to effectively, not directly, A would want to effectively convert his fixed rate liability into a floating rate liability. Okay. Okay. And then from B's standpoint, B would want to convert this floating rate liability that he has already exploited into a fixed rate liability. And that is precisely the reason that they would enter into this swap. Otherwise, there is no need. If you pause for a moment, for only a few seconds, you will see that if this is the case, there is no need actually to enter into any sort of swap at all. If somebody, for example, if B can borrow at 8.6% and at the same time SOFR at 100 basis point, B would obviously would have weighed that which is better and accordingly would have taken that advantage. Assuming that this is the case, relative basis, that is how it is coming out to be. It is but very natural that B is already existing with this liability at a floating rate. And similar is the case with this. But here we are discussing that what can even go further wrong. So it is an improvement over the existing situation. And that is precisely where they want to hedge. And they want to convert, A want to convert its liability into an effective floating rate. B wants to convert into effective fixed rate. That's how the thing is designed. Okay, now, let me tell you, in this particular case, a couple of things can happen as I discussed earlier. Assuming that there is no swap intermediary, assuming that there is no swap intermediary, this 0.55% will be shared between these two that I have already demonstrated how it is be done. So how it can further be actually be done. So A will be paying, A will be paying at a floating rate, okay, which is SOFR, okay, and 0.5, this is what he will be paying. But because of this swap transaction, his effective rate will be SOFR plus 0.5 minus 0.55, which is becomes actually SOFR minus 0.05. Remember, this SOFR is nothing but a reference rate. It could be LIBOR as well. B would be paying (8.6%) minus 0.55%. So B will effectively paying 8.15%. Okay, so the transaction in absence of any other entity will be like this, that they will enter into a fixed for floating transaction wherein B will be paying at the rate of 8.15%, and A will be paying at the rate of SOFR minus 0.05%. Obviously, it is already established that B's credibility in the market or credit position in the market is somewhat inferior to A, and that is why A is reaping this favorable advantage. So A, in fact, now is getting at 8.15%. His prime liability is at 7%, as he has already, because this portion is already existing. So that cannot be done away with. So he will be paying 7% here, and he will be keeping 1.15% here. Okay. Similarly, at the same time, this 1.15, what the purpose of this 1.15% is, I'll come to that a little later on. Similarly, since B wants to convert this liability into a floating rate liability, hence B will be getting at SOFR minus 0.05, paying this at the rate of SOFR at 0.05. Okay, because this is the cash flow that he's getting, SOFR plus 0.5 as has been determined, because this is already there existing. And then he will be paying at the rate of, paying back to A at the rate of 8.6% minus 0.5, 8.15%. So effectively what has happened, B is receiving floating here and paying this floating here. This floating cancels out. He's effectively paying fixed rate here. Okay. Of course, there is some spread element which is there, but that will always be there. The net floating rate is what he is receiving and what he is actually getting out of that. Similarly, A is getting fixed at the rate of 8.15, paying here fixed 8.15 and getting out of the whole thing by effectively borrowing at the reference rate of SOFR plus 0.5. So this is how they convert each other's transaction, each other's risk into the one which they want to hedge. Now, it is not as complex as it may sound on the face of it, and your book, as I said before, they do not do quite a justice to this. But the thing is that you can see that here, A seems to be benefiting out of the whole exercise by 1.15%. Well, this 1.15% is actually an insurance against the floating rate of SOFR, because A's anticipation out here was that the SOFR is going to go down. But if tomorrow, if the SOFR or the reference rate goes up, A will still have to pay, and he's insured up to 1.15%, but anything above 1.15% differential, he will have to pay from his own pocket as a net cash outflow. For example, just to example, let's assume that when they had entered in this transaction, the SAFR was 7%. Okay, so that means that here it is 7.5% floating, and here it is 8% floating. Okay, his anticipation was that this is going to come down, but instead, if it does not come down and it goes to 9%, see what happens. He will be now paying 9% minus 0.05, so we will be paying at 8.95%. I'm talking about A's perspective and receiving fixed at 8.15%. So net, his cash outflow becomes 0.8% negative. Okay, it is simple mathematics, nothing much. In fact, you can also construct the whole thing at your end. I'll send this PPT anyway to you guys for you to practice. But I understand that on the face of it, initially when you do it, it may sound a little tough, but it is not really. Okay. The next problem that can come in, and this is perhaps is the last of the difficulty part of it, is that if there is a swap intermediary. Okay, because what's happening is that since we are talking about these, as I said, that there could be an embedded risk of credit. One party fulfills one obligation while the other party does not. In order to mitigate that, there could be swap intermediary. Now, the swap intermediary is the one that would give the necessary protection, keep a margin, and at the same time will protect its own interest. Interest against what? Default by A or default by B. Against that. Okay, that math is not that difficult again at all. As you can see that here again, if I do it quickly, it is 1.6% here, 0.5% here. That gives us a comparative advantage of 1.1%. So that means this becomes effective benefit is 0.55% each party. But they say that the swap intermediary is now going to have its own markup of 0.3%. 0.3% would mean that 0.15% cost will be borne by A, and 0.15% cost will be borne by B. So effectively, then the advantage will reduce. The advantage will reduce by each party, which was earlier 0.55. Now, because of this swap intermediary, it will become 0.55 minus 0.15. So 0.4. Each party will now settle for 0.4 ka swap advantage only and pay this 0.15 fees to the swap intermediary, as the case may be. Okay, this is the whole kind of exercise that can actually come in your exam. Now, the last portion of our class, and this has got to do with your Forex transaction. Remember, we talked about this this particular case, wherein there is a German company, there is an Indian company, and how they would like to actually raise fund in each other's business, and what kind of difficulty that they would face. So this is the numerical part of it. Okay, so let's just simply boil down to it and see how to solve it. So in an international swap transaction between a British company and an Indian company, following are the listed details: type of swap, fixed for fixed, tenor 3 years, frequency of payment annual. The exchange rate at the initiation of the contract is 1 GBP is equal to 80 Indian rupees. Swap principal is 500 million pound, and swap rate is 5% in the UK versus 7% in India. 6 months down the line, the details change as follows, wherein first the exchange rate changes to 82 from 80, that is 1 GBP, which was earlier 80 rupees at initiation, now becomes 82 rupees. And the risk-free rate in the UK is assumed to be flat at 4.5%, while that of India is at 6%. Value the swap from the Indian company's perspective and also indicate who faces the credit risk and how. Okay. And as before, I would need some volunteer to tell me how to go about it, at least for the next 1 or 2 minutes. This is the last of the example. So I want some participation. How to go about it? All right, no problem. So as before, let's say this is UK, this is India. Okay, so here the details is that the swap transaction is fix for fix. That means the UK party is going to pay at a fixed rate. The Indian party is also going to pay at a fixed rate to each other. Okay. The swap is designed for 3 years. Okay, so this is time t is equal to 0. This is time t is equal to 3, 1, 2, and 3. T is equal to 1, t is equal to 2, and t is equal to 3. Okay. And the frequency of payment is annual. So this is going to be 1 payment here, 1 payment here, and last payment plus the principal here. And both parties will do the same thing, whether it's the Indian party or the UK party. So if it is Indian party, so the UK party is going to make the payment here, here, and here plus the principal. Okay. At initiation, the Forex has been mentioned, the exchange rate has been mentioned as 80. And the total principal is 500 million pounds. And the swap rates have been given as 5% and 7%. Okay. Now what's happening here? Let's understand. We have the UK party here. We have an Indian party here. This is the UK bank. This is, let's say this is, which company? Let's say this is Rolls-Royce. And let's say this is Tata Motors. Okay. And let's say, yes, Uday.
Abhishek, is this a currency swap?
This is a currency swap.
Won't the exchange principal at the start of the contract period?
I'm coming to that. I'm coming to that today. I'm coming to that. Good that you raised at least. I'm coming to that. Okay. So let's say this is Bank of England, and let's say this is we pick up HDFC. Okay. So, but obvious, as we said before, that this route, perhaps a direct transaction between these two parties, this route is perhaps not exercised because of various reasons that we talked before. So typically what they would do, that they will go with their request to their respective banks, exchange the principal, and then these banks will do the settlement between themselves. So remember, these banks may have hundreds and thousands of such outstanding swap contracts and other contracts in between them going on at any given point in time, right? All right, so let's see how the things would be. So initially, they would exchange the principal. Now here, as I said before, since it's a domestic, it's not an internet, it's not a domestic swap. So the principal exchange is not notional. It's a physical exchange of principal, which means that the party that is Rolls-Royce in UK will actually lend Tata Motors an amount of $500 million, and at the rate of 80, Tata Motor in turn will lend Rolls-Royce 40,000 Indian rupees, 40,000 crore Indian rupees, of course, which is close to INR $40 billion. 40 billion Indian rupees is being exchanged for 500 million British pound. That is at the contract initiation. That is physically exchange. Physically exchange would mean this company will physically remit here with HDFC Bank 40 billion Indian rupee, and this company will remit the Bank of England 500 million British pound, and then these two banks will transact between themselves 40,000 Indian rupee against 500 million British pound. So the first leg of the transaction is over. The principals has been physically exchanged. The principals have been physically exchanged. Okay, great. Now with this, let's see what's happening. So we already talked about that it's an annual payment. We already know the payment is going to be on a fixed basis. Okay, so which means that the Indian player has borrowed 500 million. It is going to pay at the rate of 5%. So it is going to pay a 5% here, 5% here, and here last 5% plus the principal, which is 100%. And the 7% rate is at India. So the UK player is going to pay 7% here, 7% here, and 7% plus the last principal here. Okay, this is how it is going to be. That's already decided. So let's then map actually the cash flow as far as these companies are concerned. So 5% on $500 million, some 500 million pound is 25 million British pound in 3 different payments. Of course, the last payment will come with the 500 million principal as well. So this is what the Indian company will pay, Tata Motors. And the British company, Rolls-Royce, they will pay 7% on the 40,000 crore rupees, which comes to 2,800 crore INR, 2,800 crore plus 40 billion Indian rupees at the end of the tenure. That's what it has been decided. Okay. Now what it says that 6 months down the line, the details have changed as follows. The forex rate has now become 82, and the risk-free rate in UK is assumed to be 4.5% now, while that in India is 6% flat for the rest of the tenure. Okay, so we are at time here. At time t is equal to 0.5 here. We have to value this international forex currency swap at time t is equal to 5 with the details that have been given. Okay, so how do we do it? Great. So it's again, all the formula are same, all the steps are same. We have segregated the cash flow. Now, since it has asked about the Indian's perspective, so what we do first is we calculate the present value of this 2,800 crore plus 40 billion into the present value. Okay. So while we have to calculate the present value, we are going to use this 6% because this is of India rupee. So we will discount this 2,800 crore by 6%. First, it will be for 5 months. Second, it will be for, sorry, it will be 6 months, 0.5 year. It is going to be 1.5 year. And the third is going to be 2,800 plus, of course, the principal, which is 40,000 multiplied by e to the power 0.06 into how much? 2.5. Okay. These are going to be the present value of all the Indian cash flow. Now here there is a little bit of a difference that I want you to understand. While discounting, I was telling you not to use the risk-free rate in the previous problem. But in this case, I'm directly discounting with the risk-free rate. Can anybody tell me why am I doing this? Can anybody tell me why am I doing this? Okay. We are doing it here by discounting it by the respective country's risk-free rate, because now the transaction is between these two financial intermediaries, and these two financial intermediaries are banks with heavy, very big credit standing. And as I said before, that this could be one of the many transactions that they might be executing with each other. So practically the credit risk between two banks of such repute is practically zero. Since there is no existential or any potential credit, I mean, if war breaks out tomorrow, etc., those are different things. But other than that, the risk is supposed to be absolutely minimal when we are doing the transaction between these two banks. Because these risks are almost negligible, hence we can safely use the risk-free rate now to discount them, because now the cash flow exchanges are happening between these two banks here. Okay, so these are the discounted cash flows, and then we sum them up for the present value of all this cash flow from the Indian perspective. Similar exercise we do for the UK company as well. Okay, so in case of UK company, we have 25 million into e to the power, discounting is 0.45, so this is 0.045 into 6 months, plus 25 million into e to the power minus 0.045 into 1.5, and then last is 500 million plus 25 multiplied by e to the power minus 0.045 into 2.5 million. Okay, now into 2.5. So there's a time. So once we have done that, what we have done, we have found out, and then we sum them. So what we have found out, the present value of the cash flow in Indian rupees, suitably discounted. We have also found out the present value of the cash flow of the UK. Now, last step, what we have to do is whatever that we get this value, then we convert into the present Forex rate. What is the present Forex rate? 82. Okay, so we convert this at the rate of 82. When we convert this into the 82, now both my cash flows now become in Indian rupees. Remember, this 82 is cash outflow, of course, and this is obviously cash inflow. This is coming from the British company side. This is what the Indian company has to pay. Okay, and as before, if we net them, that is cash inflow minus cash outflow. If we do that, then we will get the value of the contract at time t is equal to 0.5 to the Indian company. Since it is talked about Indian company, that is why we converted all the cash flows into Indian currency at the spot rate. If it had asked into British, then we would have done the same thing, but of course in the reverse manner. Okay, so if you do that, find it out, then the credit risk, the Indian perspective, the value of this swap then becomes minus of Indian 7072. That means that the Indian company is supposed to pay a net 7072 million. This is the amount that they have to pay net as a value to the UK counterparty at time t is equal to 0.5. Okay, now that you know this, can you tell me now who faces the credit risk here? Is the company in UK or the company in India? Which faces the credit risk?
Indian company.
Sorry?
The Indian company faces credit risk as it is supposed to receive 7,000.
No, it is not supposed to receive. If it had supposed to receive, then this would have come with plus. This has come with minus.
Sorry. Yeah, sorry, minus.
Since it has come with minus, that means that the Indian company on a net basis has to give this money as part of the value. We're talking about the value. Okay. This value is now accruing to the UK counterparty. So the credit risk is now being borne by the UK counterparty, not the Indian company, not by the Indian company. Okay, so this actually summarizes all sorts of problems that you can think of as far as your swap is concerned. And thanks for bearing me. We started off with, I think, 16 odd people, and we are left with now 6.
Abhishek, one query. The initial currency exchange that isn't been discussed here.
I'm sorry?
The initial currency exchange that point didn't get discussed in this question.
No, I did discuss. I did discuss. Look at this. I did discuss. Now how the currency will be exchanged is that this person is going to place 40,000 crore with HDFC Bank, and this company is going to place 500 million pound with Bank of England. And then HDFC will give Bank of England 40,000 crore Indian rupees, 40k crore Indian rupees, and receive 500 million GBP pound. That is how it is exchanged. And exactly after the tenor of the swap is over, this principal is being re-exchanged back. So the HDFC Bank will give back 500 million. Obviously, Bank of England or whichever bank will give back this 500 million to the original company. And similarly, this 40,000 crore from the Bank of England will come to HDFC. HDFC will give it back to Tata Motors. Is it clear, Uday?
So yeah, it's clear. So these particular transaction won't be affecting the value of the swap.
Yes, we are talking, as I mentioned before, quite a few number of times, we are talking about a value here, value, not the exact cash flow exchanges, because cash flow exchanges is not material here. We have been asked to calculate the value and who this value is accruing to.
Okay. Yeah, got it, Abhishek. Thank you.
Okay. Thanks everybody. Thanks for being patient, and I hope you enjoyed. Though this was quite a boring lecture, I can understand, but it's a difficult topic area. But I hope I did make some difference. And if you have been patient here, I am sure that it is going to help you in your future course. Thank you very much.
Thank you.
Sir, everything is on fine. So can you share some non-numerical questions regarding this?
Yes,
topic?
I would. Who is this? Karan, right?
Yeah, Karan.
Yeah, Karan, I would. You see, the reason that I took you guys through the numerical question is because if you put some painful effort in understanding the numericals, the theoretical will become that much more easier. But nonetheless, I will share the list of questions on the theoretical as well. But having said all of this, please do practice from your book or any other material, any other source that you can actually lay your hands on. Do actually practice the numericals. That is going to help you.
So today what we learned, sir, swap is only this much, or we can see more behind this?
No, nothing. There is nothing more than this as far as numericals and whole concept is concerned. This is even more than what actually your syllabus actually covers. There is one particular area that remains. I would not say that because that is not covered in your curriculum, should have been, and that is part of the swap duration. The swap duration is not, I mean, you may correct me referring to your book if that has been covered in your syllabus or in your curriculum or not. If it is covered, then I will do a short note video and upload it in YouTube for all of you to understand. But other than that, there is nothing that is left to imagination. Everything is covered.